Here we are continuing with part two of chapter one, the financial reporting environment. Here you'll see in Exhibit 1.3, it summarizes the various groups involved in the financial reporting process. Financial reporting takes place in a complex and dynamic world. Financial statement users' information needs change as business evolves. So it is natural that environmental factors such as legal, economic, political, and social, they shape and influence the financial reporting process. The environment is the fourth element of the financial accounting definition. Financial accounting interacts with its environment in both a reactive and a proactive fashion. Financial accounting reacts to pressure, such as politics or lobbying, from various groups and changes in its environment. Accounting theories and procedures evolve to meet the dynamic changes and demands from the environment. For example, you have the FASB. FASB made changes in the accounting for off-balance sheets, subsidiaries, following the discovery of, the massive fraud scheme at Enron. Remember back in the 2000 in the early 2000s when we had the financial crisis? So during that time, FASB made changes in the accounting for off-balance sheet subsidiaries. Accounting conforms to economic conditions, legal standards, and social values. Today, accounting disclosures highlight a company's policies regarding pollution control, community service, and diversity in business. For example, in the letter to the shareholders in Johnson & Johnson 2015 annual report, CEO Alex Gorsky highlighted Johnson & Johnson's legacy of caring through strategic partnership. You'll see a copy of that letter here at Exhibit 1.4. Now, the development of accounting standards is also a political process that is heavily influenced by the various groups in the reporting environment. You have the lobby groups. Lobby groups include investors, creditors, financial analysts, the financial community, academics, accounting organizations, and industry associations. Financial accounting is proactive. It's proactive in that it can change or influence its environment by providing feedback information that is used by organizations and individuals to reshape the economy. Accounting information is used to efficiently allocate resources throughout the economy by directing capital flows to their most productive uses. For example, the startup capital. Startup capital is needed to develop new technologies such as solar power and electric vehicles. Accounting standards can also influence managerial behavior. For example, expensing research and development costs may slow investment in research during economic downturns because this accounting treatment results in lower earnings figures. So here we're going to check your understanding. Objective 1, define financial accounting and describe the demand for financial information, including the role of general purpose financial statements, the information needs of financial statement users and other parties, and the factors that influence financial reporting. What are the four basic financial statements? What are the four basic financial statements? Yes, your balance sheet, the income statement, cash flows, and shareholders' equity. So here we are at learning objective 2. We're going to discuss the role of financial accounting standard setters in the U.S. and internationally. So standard setters, they work diligently to develop concepts, rules, and guidelines for financial reporting that will satisfy the requirement to accurately present the economic performance and financial position of the firm. Now, these standards are designed to encourage transparency and truthful reporting. Publicly traded entities must follow the rules. They must follow the guidelines set forth by the standard setters to maintain public trust and also to ensure the efficiency of the function of capital markets. Why is it important for an accountant in the U.S. to learn international accounting standards? Why is it important for an accountant in the U.S. to learn international accounting standards? Well, there are several reasons. One is U.S. companies operate subsidiaries outside the U.S. So many of these subsidiaries report under IFRS in their home countries. So accountants must convert the subsidiaries' financial statements to the U.S. GAAP when preparing consolidated financial statements. For example, Johnson & Johnson. Now, Johnson & Johnson operates in more than 60 countries throughout the world. And there are several other companies that operate throughout the U.S. Another reason is that non-U.S. companies operate in the U.S. and prepare the financial statements using IFRS. So consequently, if you are working at or you're auditing an international firm, you will likely see IFRS. For example, the company GlaxoSmithKline. GlaxoSmithKline is a company, is a pharmaceutical company, of course, that's based in the United Kingdom. But 18% of their employees are in the US and at their US headquarters in Philadelphia. Another reason is the SEC permits the use of IFRS. The SEC permits the use of IFRS-based financial statements by international companies with shares trading on the U.S. stock exchanges. Now, U.S. accountants and auditors, they often assist these non-U.S. companies in preparing the U.S. regulatory reports. As of September 2016, these companies, they represent a worldwide market capitalization in excess of $7 trillion across more than 500 companies. Now that was as of 2016. Why is it important for accountants in the U.S. to learn international accounting standards? The SEC promotes high quality, globally accepted accounting standards. U.S. accountants and auditors, they need a working knowledge. They need a working knowledge of the IFRS. They need it in order to implement global standards in companies and perform audits. Many U.S. accountants now spend time working outside the U.S. So the IFRS is required or permitted in over 130 countries worldwide. So the accounting profession has determined that a working knowledge of IFRS is important for today's accountant. It's important for today's accountant. And if you're planning on taking this, the CPA exam, know that the American Institute of CPA, they test IFRS on the CPA exam. Here at Exhibit 1.5, it presents a map that highlights the countries that require IFRS in red. As you can see, it's many, many, many countries. Check your understanding objective 2. Objective 2, the learning objective was discuss the role of financial accounting standard setters in the US and internationally. So the question here is, what body sets accounting standards in the US? What body sets accounting standards in the US? It is FASB, the Financial Accounting Standard Board. FASB sets accounting standards in the US. Question number 2. What body sets global accounting standards? What body sets global accounting standards? And the answer is the International Accounting Standards Board, IASB. They set global accounting standards. We'll go into learning objective 3. Detail the standard setting process. Detail the standard setting process. Here you see in Exhibit 1.6, it presents the history of the U.S. standard setting, as well as pronouncements issued by each group. I want to just give you a brief history of the standard setting. U.S. financial reporting standard setting began in 1934 with the Security Exchange Act. And that act gave the SEC the power to promulgate accounting standards for all publicly traded firms. The SEC delegated its standard setting power to the private sector, prompting the accounting profession to establish the first U.S. standard setting board. Now, the Committee on Accounting Procedures, CAP, was formed in 1939 as a subcommittee of the AICPA to reduce the number of accounting methods used in practice. However, prior to the formulation of the CAP, the Committee on Accounting Procedures, there were significant inconsistencies in the form and content of financial statements. So CAP produced 51 standards, and it's referred to as Accounting Research Bulletins. The ARBs are bulletins. But in 1959, the CAP was replaced by the Accounting Principle Board, which is the APB. The Accounting Principle Board, another subcommittee of the AICPA, issued pronouncements known as opinions. Now, the APB's primary objective was to respond to existing and emerging problems in financial reporting. The Accounting Principle Board, the APB, they issued 31 APB opinions and 4 APB statements. In 1973, the Financial Accounting Standards Board was replaced by the APB. Which is FASB, the Financial Accounting Standards Board. So FASB is a more independent board than the APB. The 7 members employed as a full-time board members must serve all relationships with outside entities. In addition, FASB board members do not have to be accountants or CPAs. Did you hear that? FASB board members, they do not have to be accountants, nor do they have to be CPAs. The members can join the board from industry. They can join the board from education and public service. Members of the board have represented a broad range of constituencies, including members from the corporate world, the accounting profession, investment community, government, and academia. FASB is not a subcommittee of the AICPA, and it is not affiliated with any professional organization. Again, the FASB is not a subcommittee of the AICPA, and it is not affiliated with any professional organization. The FASB currently issues accounting standards updates as part of the Accounting Standards Codification, which is the single source of GAAP in the US and includes all pronouncements issued by any of the standard setting bodies that have not been superseded. Here in Exhibit 1.7, the FASB is part of a larger organizational structure that also includes the following. You have the Financial Accounting Foundation, the FAF. The Financial Accounting Foundation is responsible for the oversight, the administration, and the finances of FASB. The FAF obtains funds primarily through the Public Company Accounting Oversight Board, the PCAOB, which assesses charges known as accounting support fees against issuers of equity securities based on their market capitalization. Other sources of funds include publications, subscriptions, and contributions from state and local governments for the GASB. GASB, which is the Governmental Accounting Standards Board, they set standards for state and local governmental units. The Financial Accounting Standards Advisory Council, the FASAC, they exist to advise FASB on technical issues. And the Governmental Accounting Standards Advisory Council, they serve as an advisory board to the GASB. a lot of standard setting structure. The FASB follows a 7-step process to issue a final standard. There are 7 steps. One is identification of an issue. Now, the FASB identifies a financial reporting issue based on recommendations from analysis, government agencies, or other market participants. Step 2, decision to pursue. Now, after consultation with FASB members and others as appropriate, the FASB chairperson decides whether to add the issue to the technical agenda. Step 3 involves public meetings. Now, once added to the technical agenda, the board holds public meetings where it deliberates the various issues identified by the FASB staff. Step 4, exposure draft. The board issues an exposure draft, or ED, which is intended to solicit input from financial statement preparers, auditors, and users of the financial statement. Step 5 involves public roundtables. That's when the board may hold public roundtables to discuss the ED, which is the exposure draft, if needed, of course. Step 6 is re-deliberation. The FASB staff analyzes the comment letters received from preparers, financial statement users and auditors, public roundtable discussion, and any other information. Then the board decides on re-deliberating the issue. And step 7, which is the publication of the final standard. It is at this step that the board issues an accounting standard update, ASU, which is the final standard. It requires a majority vote of the board to issue a new standard. The accounting standards update will then be incorporated into the body of the accounting standards codification that makes up the US GAAP. Until recently, most countries established their own accounting standards. For instance, in France, Germany, and Australia, they each had their own GAAP. Now, the GAAP of each nation, they vary due to the country's specific needs for accounting information. Those factors may be, according to the country's sources of capital, which involves, tax laws, its culture, or other regulation influence the development of the accounting standards. Given almost 200 countries in the world and almost as many sets of different GAAP standards, global investors and creditors, they struggle to compare accounting standards when analyzing companies and making investment and a credit decision. Recognizing the need for comparable accounting information internationally, the professional accounting organizations from 10 countries form the International Accounting Standards Committee, the IASC. They established that back in 1973. Now, at that time, the IASC consisted of up to 16 part-time volunteer members setting international accounting standards. Now, companies in each country could adopt IAS on a voluntary basis. However, the IASC was criticized for allowing highly flexible accounting standards. So as a result, most major developed countries, they continued to require the use of their own standards. As a global business relationship continues to grow, the need for a comparable and rigorous international set of accounting standards became apparent. In the 1990s, the IASC, they initiated an improvement project to develop a cohesive and uniform set of core accounting standards. The IASC initiated an improvement project to develop a cohesive and uniform set of core accounting standards to meet the needs of investors in cross-border offerings and exchange listings. Now, shortly after this improvement project was completed, the International Organization of Security Commissions endorsed IAS for use in cross-border stock offerings and listings, allowing companies to report under IAS within their jurisdiction and on their exchanges. Around the same time, the IASC began to recognize limitations in its existing organizational structure. As a result, the International Accounting Standards Board replaced the IASC in 2001. The IASB now promulgates standards called the International Financial Reporting Standards, the IFRS. The IASB also developed a set of accounting standards to address the needs of private companies called IFRS for small and medium-sized entities. The IFRS for SMEs is based on IFRS, but eliminates certain costly reporting requirements that are designed to provide information to external financial statement users. So the IFRS for SMEs, which is small and medium-sized entities, was developed because some countries require all public and private companies to prepare financial statements under IFRS. Now, these countries can then allow private companies the option to use the less costly IFRS for SMEs. A lot of acronyms, right? Yeah, a lot of acronyms. Here you see in Exhibit 1.8, it presents the history of international accounting standard setting. Countries come together to develop international standards. You have the International Accounting Standards Committee, started in 1973 to 2001, and then it was replaced by the International Accounting Standards Board in 2001 to our present day. Any questions? Here in Exhibit 1.9, you'll see that the IASB is part of a larger organizational structure. The IFRS Foundation oversees the IASB and is responsible for financing the IASB's operations. So unlike FASB, the IASB relies on contributions. They rely on contributions from companies and other parties that have an interest in promoting international accounting standards. The monitoring board was formed in 2009 to enhance the public accountability of the IFRS Foundation while still allowing for independence in the standard setting process. The monitoring board oversees the IFRS Foundation. It participates in nominating individuals to serve as foundation trustees, and they also approves appointments. The IFRS Advisory Council, they advise the IASB and the IFRS Foundation on many issues. Some of them include the IASB agenda and the implementation of standards. The IFRS Interpretations Committee is the body of IASB, similar to the EITF in the US. The IASB is composed of 14 members. They have 14 members who are appointed by the IFRS Foundation Board of Trustees. And at least about 11 members, they say, are full-time, and no more than 3 can be part-time. So to ensure broad and diverse international representation, the IASB is composed of 4 members from the Asia, Oceania region, 4 members from Europe, you have 4 members from the US, 1 member from Africa, then you have 1 member appointed from any area, subject to maintaining overall geographical balance. The IFRS Interpretations Committee, they develop interpretations of standards that must be approved by the IASB. Whenever the need arises, the IFRS Interpretations Committee, they form working groups, which are task forces for individual agenda projects. The IASB will also normally form working groups or other types of specialized advisory groups to advise on major projects. An example of a major project is the Emerging Economies Group. The IASB, they follow a similar process to the FASB standard setting process. So, okay, when a topic is identified, the board considers the nature of the issues. They seek input from its constituents, and they prepare an exposure draft. After receiving comments on the exposure draft, the IASB may modify the proposed standard before approving a final standard. However, unlike FASB, the IASB is required to carry out a post-implementation review of each standard or significant change to an existing standard. The review focuses on controversial issues identified during the development stage, unexpected costs, and implementation problems. Now, this review is normally carried out up to 2 years after the new standard has been in effect.